Hello, everyone, and welcome to our SaaS Market update. I'm Alexis Scorer, and I'm joining you from our London office in Mayfair, where there's been a flurry of activity ahead of the Jubilee celebration. So you might hear a few helicopters in the background. Great to see so many founders and CEOs and familiar names joining us this afternoon. With me for today's session is my colleague, John Cantwell, who's joining from our San Francisco office to give an update from Silicon Valley and take us through US perspectives on the SaaS sector for 2022. Also with me today is my colleague, Matt Stamp, who's going to provide a quick update on the market here in the UK and current deal activity. And Matt's going to be kicking off the session in a moment. And we're also delighted to be joined this afternoon by Adam Greenwood-Byrne, CEO of RealVNC, to talk about bootstrapping a SaaS business and finding the right partner for growth. Quick reminder, any of you can submit questions during the fireside chat using the Q&A button that you'll find at the bottom of your screen, and we'll do our best to cover as many of these questions as we can during the session. So with that, I'd like to hand over to our first speaker. Matt, over to you.
Hi everyone, great to be with you as part of this webinar, and thanks for that intro, Alexi. So let's move into a quick update on the UK market. So clearly we're moving into a period of economic uncertainty, a perfect storm of inflation, geopolitical turmoil, and then the elements of COVID that are still there in the supply chain. And all of that has driven this period of economic certainty that we are potentially going to experience over the next 6 to 18 months. And that has an impact on the public markets. And what we'd like to talk to a little bit today around is what we're seeing in the UK private and public software markets, where there is resilience and where we have seen impact. Before we chug into that, clearly, as seen here at the bottom of the slide, you can see the relative impacts on the UK bourses. There has been a sell-off in global markets that has impacted us here in the UK. That has had some impact on the overall public software stocks. But actually, there has been some resilience. You can see based on the constituent parts of the UK market that actually the market has performed better than the US and is actually up versus where it was in January 21. So what does this broader economic environment mean for both public and private SaaS stocks? If we move on to the next slide, here you will see an illustration of SaaS companies on the UK public markets. So what we've done here is we've taken the constituents from our global SaaS profile and turned them into a UK market to illustrate relative performance, both on a standalone basis and against the broader global index. So what you can see here is the impact of the sell-off since November, December last year, and moving down 39%, so a drop in the EV to LTM multiple of 39%, which in relative terms is not as broad as the US market, for example. That has pushed the median, the average multiple over the last 5 years back to the median level that we have experienced at 4.5 times. So we have seen part of a sell-off, but to put that in broader context, again, if we move to the next slide, you can actually see that from a comparative basis, the UK SaaS market has not seen the level of volatility that we see globally. Why is that? Well, clearly within the global index, you have a significant number of the broader US growth SaaS stocks that were very much responsible for the great bull market we saw across COVID and to the highs of 25 plus times revenues. In comparative terms, those growth stocks are quite different to what we have in the UK. So the UK listed SaaS players have been on the stock market for over 5 years in all instances and are generally profitable, slower growth SaaS businesses. And therefore you can see they trade in a relatively predictable range, which means, yes, they have been hit somewhat, but no way near the contraction in global SaaS valuation. And I think that points to several trends that we are seeing in the markets, right? Investors are valuing profit and resilience over growth. And we think those themes will continue in both public and private markets. And to illustrate the point, if you look at the drop-off in the global market on a kind of NTM basis to EV, that's 52% versus only 24% in the UK. So quite a difference in how the market is looking at those two groupings. So moving from the public markets to the private markets, and some much better news, I think, in terms of M&A activity. So what have we seen in Q1 and Q2 this year? So we've seen resilient levels of M&A as backed out by both Q1 and Q2 volumes and values to date. Why are we seeing that resilience? I think point one, there is still a significant wall of private equity, strategic capital, and debt capital funding M&A throughout the UK market. That wall of money, coupled with strategic need and investors' desire to put more into the category, has continued to drive activity. In addition, if you consider the fabric of the UK market, where we have almost 20 different large consolidators across different vertical and horizontal markets, 2/3 of which are backed by European and U.S. private equity, those parties drive a significant amount of activity. For example, 50 of the deals in the last 12 months in the UK have been driven by the top 7 consolidators. As you will see on the breakdown between financial and strategic buyers, that is one of the trends that's responsible for strategics outbidding and outmaneuvering financial buyers. So 89% of those acquisitions this year have been from strategic acquirers, which is not comparable to the US and European markets, quite specific to the UK. In terms of the type of deals that we see, there's some great examples on this slide, the bigger deals that capture those trends. So for example, private equity putting significant capital into profitable, growing markets in which they can see further growth and buy and build opportunities. So for example, Nordic Capital putting further capital into RL Datix in the healthcare space. Fortero's recapitalization by Partners Group from Battery Ventures, again, an ERP software-focused European buy and build play. And most recently, Ideagen's current pending offer from HG Capital at a strong valuation backing the GRC buy and build platform to take private and develop further M&A. And again, the other deal on here, the Global Shares deal, is a great example of strategic deployment of capital. JP Morgan paid a double-digit revenue multiple for the share incentive platform. So moving on to the fundraising market, what do we see here? So again, we're seeing some resilience, although probably signs of slowing. So if we consider Q1, the market was still relatively strong for fundraising, but I'd argue that the volumes are now coming down a bit, and we're seeing a little bit of delay or holdback in the market. Notwithstanding that, some of the trends that have been true through the last 18 months still run true in the fundraising environment. For example, category winners with strong unit economics are still able to raise capital. And I think the other function of that is, again, like the public markets and the M&A markets, a focus on short to medium term profitability is another part of that appraisal that investors are taking. Again, in accessing these markets, you can see lots of chunky late stage rounds, as evidenced by Checkout.com's latest fundraise, wealth tech provider FNZ raising another $1 billion for their M&A fuels European and international M&A growth, GWI raising money from Permira, to name just 3, and then Paddle able to raise $200 million to engage in strategic M&A from KKR, again, in the last month. So I think, for the right assets, there is still plenty of funding available for fundraising, but in the wider economic environment, as people consider the impacts of a potential recessionary environment, there is a consideration of which sectors and which models do people want to invest in, and a bit of a holdback from growth at all costs. So finally, looking forward, what we've done here is just illustrated UK software deals by subsector over the last 3.5 years, disclosed deals over 50 million. And this will illustrate a couple of the fundamental trends and sectors that we think will be important. But macro, we see the M&A environment continuing to be strong. We see the wall of capital that's out there, demand outstripping supply, the consolidators, the private equity houses, and the strategics fighting out for the right type of assets, and all of that leading to a strong M&A market. And also valuations, to touch on that, again, we would have seen this through the idea gen public to private. The latest rumors about Access tripling their valuation to 9 billion, raising more capital. Both of those deals done at double-digit revenue multiples, high 20 forward-looking EBITDA multiples. So for trophy assets, there is strong pricing, and we see that pricing right across the market for good software businesses. So that availability of capital will continue, I think, to make the market strong. And there's still a good lineup of assets coming to market. One statistic for you, if you take the top 20 private equity-backed UK software businesses by vintage, i.e. those that are 4 years or more older in terms of their private equity ownership, the top 20 have a conservative value of 8 billion. So that's 8 billion worth of assets probably coming to market in the next 18 months. So for all those reasons, we think M&A will still be an area that we're very active in, and to focus on 3 or 4 specific subsectors that have been borne out by, again, the last 2 to 3 years worth of activity. VMS, so vertical market software, will continue to be strong, generates really strong leaders with really strong margins who can really dominate a growth market. Cybersecurity and infrastructure clearly will continue to be important in the current geopolitical domain. Cyber will see more and more money going in and more M&A. And then we very much like specialized sectors such as HCM and healthcare software, where again, we see a continuation of significant activity. I'm now going to hand over to John, who's going to give us the stateside perspective and talk us through the latest US SaaS dynamics.
Thanks, Matt. And great overview of what's going on in the UK in software. From a US perspective, I think we're seeing a lot of the same trends, but it's more of a global perspective that we're seeing. In this first slide, you can see the GP Bullhound SaaS index that we track globally. There's about 75 public companies, across the world in this composition, and you can see over the last 5 years, there's been a nice run up in SaaS, and then that was really highlighted in 2020, 2021 with kind of the COVID boost. There has been a drop off, obviously, in the last 4 to 6 months, and we now see the group trading at between 5 and 6x revenue on a average basis. Still healthy valuations, we think, in general, and Matt's point about a flight to quality is certainly true. So the better companies are seeing much higher valuations. I'd also say that the private companies, while over the last couple of years they didn't see as high of an increase, relative to the public companies, they also haven't seen as low of a decrease relative to the public companies. So we think the private markets has stayed a bit stabilized, through both ends of what we're seeing in pricing. And we'll get into in a minute, some of the breakdown between, some of the higher quality companies and less quality companies, and how that relates to valuation. So on the next slide, you can see deal activity is still there. I mean, these are deals all done in the last couple of months. We see a lot of strategics still being active, with Salesforce buying a company recently, Synopsys doing a big software deal, HP, AMD. There's still a lot of transactions, especially in some of the hotter subsectors like security or healthcare related software. We've seen a lot of activity in those two subsectors in particular. And then on the right, certainly still large financings are happening. Dragoneer, Insight, TPG. The private equity market has raised, so many large funds over the last 5 to 10 years that there's still a ton of capital on the sidelines, ready to be deployed into SaaS, and I think that's still a big focus of a lot of the funds. They certainly are being, more picky in terms of looking at burn rates and looking at things like retention very closely to make sure the companies are of enough caliber where it makes sense to invest, and they have really high quality customers and revenue and those sorts of things. But still a lot of capital going into the market for sure. And then going back to the strategics, I mean, we've seen this in other times, like in 2016, I think there was a drop in SaaS valuations, down to like 3 to 4x revenue. All the big software consolidators then went on an M&A tear, and Oracle bought several companies. Salesforce was very acquisitive, Google very acquisitive. So they saw companies as being, better priced than kind of the 15 to 20x multiples. And they were active and it led to a lot of deal making, again, still at healthy levels. And so we predict that will happen again, this year and kind of going forward. On the next slide, we do break down our SaaS index a bit, and you can see we have a high growth group, a median growth group, and then a low growth group. And the groups are done based on growth rate, and they're all public companies. And the data is a little funky when you go back to like 2017 and 2018, just because there were less companies in the index, and some companies have come into it since then, after going through an IPO. So I would focus more on probably the last 2 years on this chart. But what you could see is there was a huge premium for high growth in 2020 and 2021, and now that's come back, and so high growth and medium growth are pretty close to the same multiple, and then the low growth is a lot different, right? It is very much, call it 3 to 4 turns less in terms of the revenue multiple. So something we look at, and then what's not factored in here, what I mentioned before, are burn rates. So I think a lot of times the higher growth companies have higher burn rates, and so burn rates are being penalized, in this market. So that sweet spot of the medium growth with controlled burn is we think a good position to be in as a company. Next slide. This is our rule of 40 analysis. So you have a bunch of public software tickers out there, and you can see the ones kind of in yellow who have achieved the rule of 40, and then the ones in black who have not, in the universe. And it's maybe 60% have the rule of 40, 40% do not. On the next slide, you could see how they trade relative to a revenue multiple. And in general, the companies that have rule of 40 trade better, not in all cases, but in general, you can see those dots are more up and to the right, and they're being rewarded. And I think we'll still, again, see that in this type of a market. And then finally, we touched on this before, but we've picked a few companies, and we've included GP Bullhound SaaS score. So this is revenue growth plus free cash flow margin, which is your typical rule of 40, but we've added in net dollar retention or net revenue retention. And you can see as you have that retention number factored in, the companies with good retention are also trading, much higher, and will have better LTV to CAC ratios and things related to retention. But we think that's one of the most important factors in terms of pricing right now in the market. And we're seeing that both in the public and private markets as well. So that's a quick overview on the U.S. SaaS market, and I'll turn it back to Alexis for a fireside chat.
Thank you, John. Great to hear those US perspectives and insights on valuations. It's worth underscoring that despite the turmoil in the public markets, we've closed 14 transactions so far this year, including SaaS deals here in the UK. And, as Matt mentioned, we're still seeing both strategic buyers and financial sponsors paying decent multiples for good businesses. So from Silicon Valley to Silicon Fen, I'm excited to introduce our next speaker, Adam Greenwood-Byrne, who's joining us from Cambridge. Adam is the CEO of RealVNC, a remote access software business founded by the original inventors of virtual network computing. And his clients include companies like AstraZeneca, Disney, Google, Intel, and NASA, to name a few. Adam, great to have you with us, and thank you for joining.
Well, thanks for inviting me, Alexis. It's great to be here.
So yeah, I thought I'd ask initially about your path to becoming CEO, Adam. Perhaps you could give us a little bit of a quick background on RealVNC and how you got involved in the business and how you ended up being CEO of a growth stage software business.
Yeah, sure. So, I mean, firstly, just to introduce RealVNC, it's a concept that's pretty easy to explain. And actually, your evocative video right at the beginning did a good job of that and talking about running international businesses from a laptop in a coffee shop. Effectively, that's one of the things that we enable. So we are a remote access and takeover solution, allowing you to control any device from any other device across the internet. So where you'll have likely to have seen this really is in tech support. If you've had a problem with your laptop, IT support person has come on to fix it, taken control of your keyboard, your mouse, fixed remotely, and then got out and allowed you to continue working without having to jump in a car or come desk side or any of that stuff, and minimizing your downtime. That's exactly the solution that we invented back in the late 90s, that technology to do remote control. I wasn't around then, so the business was founded by some smart PhD grads, effectively from Cambridge. And I, in fact, didn't join the business until much later in 2009. I kind of describe myself, just by way of introduction to me. I've never really said I'm a software engineer, although that's within my capabilities. I'm a web developer, a mobile engineer. I could do those things, but really, I've always thought of myself as a problem solver because my academic background was in maths and computer science at Oxford. And it just happens that technology is the tool that I've been using throughout my career to solve problems. And I think that's the true meaning of the word engineer. And so my background was really in running MSP businesses, so managed service providers, providing outsourced IT technical support, essentially, and disrupting that market. And so actually right from my very first business, back in the late 90s, I knew about RealVNC and I'd used it, and I really understood how valuable that technology was, because it meant that my engineers could work very efficiently. They didn't have to jump in cars and travel hundreds of miles to client sites to resolve complex problems. They could do it from the comfort of their desk, or in fact now from the comfort of Starbucks or wherever, in fact. And especially in pandemic times, that's become really important. And I don't think we'll ever move away from a need for remote working. So really, really powerful technology. So I'd been scaling managed service providers and then consulting businesses, got into big IT consulting and running big technology projects. Again, lots of use for remote takeover there and big infrastructure projects, that sort of thing. But I think I was frustrated scaling people businesses, honestly speaking, because it's hard to hire bright people, and it just takes a long time really to scale a good people business. And I really saw an opportunity with RealVNC. I'd been using it for years. I was a real evangelist and wanted to get involved with the product business. And the opportunity I saw really, which I pitched the founders on back in 2009, was to license their core intellectual property, because they'd invented this stuff, right, into device manufacturers, and essentially charge them, an annual license fee, and create, more importantly, an ongoing royalty stream. So we would get paid when OEMs built remote takeover capabilities into their hardware. And for some crazy reason, they accepted my proposition and thought that I was credible, and I joined the business. And actually, in my first month, I remember this, because there was sub 2 million revenue business at that time doing perpetual license software. And in that first month, I wrote 300K of business against an annual sort of sub 2 million business. And went on really from there to sign up brands like Intel, Comcast, John Deere, Siemens, GE Healthcare, for example. And so I really got the attention of the founders quite quickly. And I think because I was doing customer work for big brands with actually, quite big checkbooks, I quickly got kind of no holds barred access to the engineering team. who were at the time, building products. They were building end user products, so selling RealVNC remote access software online via e-commerce. So there was an opportunity cost of taking those engineers off mainline products and saying, hey, actually, I want you to work for Comcast and I want you to build this thing on this crazy different hardware platform and this crazy operating system. But trust me, there's a big check at the end of this. It's going to be fine. That's not an easy sell sometimes. But they built, I had them build a bunch of prototypes and proof of concepts for high value customers. And I guess, and had a lot of success there. And I think then the snowball effect of from there, I started having more innovative ideas for the mainline product and really ended up leading that product development then, not just the bespoke software for the OEM customers, but leading product and eventually transitioning us from a perpetual license business to that SaaS subscription model. And all this under the guise of effectively being a sales manager or a VP sales and all that kind of thing. So I was sort of punching above my weight, really. And I think the founders saw that, they saw my energy for growth, my ambition for change. And I think as well, they were quite sort of self-aware of the fact that they were coming up to kind of retirement age, well, sort of early retirement, ideal early retirement age. And I think it was just, after everything that I'd achieved in the first few years at RealVNC, I think it was quite natural for me and for them to sort of groom me to lead the next generation leadership team. And I think, I say it was natural. That sort of implies that it was quite an easy path. It definitely wasn't. But I hope everyone's glad that we got there in the end.
I'm sure they are, Adam. And so what were the key challenges and learnings from making that transition from a senior sales role into the CEO seat as a non-founder?
Yeah, reflecting on my career, I've actually done this to myself quite a lot, come into businesses and kind of try and insert myself into the management team. I think maybe that speaks to having a problem with authority or not wanting a boss or whatever, I don't know. But anyway, and look, I think probably any of the founders on the call might be able to relate to this quite well, because if somebody comes to you and asks you to kind of cede control of the thing that you've put your blood, sweat and tears into, and you've worked those 18-hour days, and you've fought tooth and nail for, and you've maxed out your credit cards and all this kind of stuff to keep alive, that's a really big ask. But I think actually this was even bigger in a way, because this wasn't just a business they'd founded. This was a technology they'd invented straight out of university. So this really was the whole of their commercial life, effectively, their life's work to create a market for something that they'd invented, and then build a business around that, exploiting that opportunity. And I think asking them to trust me, an outsider, and also, someone who doesn't hold a PhD from the University of Cambridge. Okay, I went to the other place, but there's a certain amount of competition there. But yeah, to trust an outsider and not just to be a safe pair of hands, but actually to take the business on quite a complex journey of change is a big ask. I think the one thing that was important was realizing that for them, it wasn't really all about revenue and profit. Those weren't the things where their concerns lied, really. I think they really valued the culture they'd created in the workplace, and they'd fought for that, and they'd worked hard to create that, secure and stable employment for local, bright, talented people. And really also like every engineer, if you've invented something, your prime concern is to ensure the longevity of that technology. So they're not going to give that up easily. And I think, as engineers, your success really is derived from seeing your technology out in the marketplace, seeing it solve a problem that millions of people around the world share. That's a real driver beyond the pounds, shillings and pence, really. So, and I think having that engineering background myself, I really understood that. And I think I demonstrated the respect for those aims in everything that I really did. That was quite pervasive. And I think, that being said, I think all the while I kind of reinforced that message that change was really the only thing that would see this technology survive in the in what had become quite a highly competitive landscape. And after all, it's a really attractive market, the one we're playing in. And so everybody wants to share, and not least, especially in the last few years, with what happened with the pandemic and remote working and the new normal, or whatever you want to call it. It's whether you're in web collaboration or screen sharing or all of these things, all of these technologies are never more relevant. And I think once they'd realized that they were actually in a race, and they knew that the energy that I had and the ambition that I had was what would take us forwards. And I think just finally on the culture piece, I was also never particularly counterculture. I challenged them on certain things, but actually I really embraced our heritage as a business. And I think so much so that I probably even convinced myself mentally somehow, how we really, after a while, if we keep saying something that's untrue, we believe it ourselves. I actually really convinced myself and felt like a member of the founding team at times. And I think maybe that's to their credit as well. They made me feel like that. So they gave me that license. And so, and to feel like that was a conscious decision. I think I am passionate about this technology. I'm passionate about the insights, the impact it has. So I am a true evangelist. So I think somehow I'd landed in the right place, I suppose. And I think the founders saw that. But again, it took many years. I mean, look, I started in 2009. So this is on my 13th year anniversary is coming up in a month. So, it was a long journey to get here.
So what happened next? So you're a few years in, having taken the helm, you're sort of well established as CEO, you've navigated your way through the SaaS transition. What was the catalyst for deciding to start exploring strategic options?
Yeah, I think this is where the sort of frustration as incoming management team comes in. And I think because how to put it, and I have nothing but absolute respect for the founders. So let me put that first. But what happens as you get further into your journey as an entrepreneur and potentially older in your years as well, is that you do become a bit more conservative. You have a little less appetite for risk, because what you want to do is protect what you've got. And as human beings, we're really programmed to protect what we've got way more than we are to bet it all on a big bet and go after something quite extraordinary. And I think for me, I suppose I wanted to feel free to have a different attitude to risk than had gone in the past, I suppose. And I saw that in order to maximize the opportunity in this very highly competitive landscape, we would need to have a different attitude to risk. And the main reason for that is, and let's be clear about this, the business had really prized profit and putting money into the bank, really. So we had a really big bank balance, which is a great thing to celebrate. But actually, to me, that felt really unambitious, because I just thought, like, if we really are sure about what we're doing, if we think our marketing team are onto a good thing, if we think the product is great, then why don't we invest that money behind it? Why don't we, put it into performance marketing, do more paid ads, do more SEO, revamp the website, hire a UX design, whatever it took to grow. I really wanted to bet on ourselves. And so I wanted to be in that position to trade profit for growth, I suppose. And just knew that was something I'd have to do. And I think it became quite clear to me that in order to do that, I would need to explore a way to, a way to exit the founders and give them what they wanted in a win-win way. So I think and again, coming to this conclusion and learning about it was quite a long journey. I mean, I'd only ever run privately held, privately funded businesses. So that journey of discovery, just even to know what the options were, and the pros and cons of each, I think I very quickly realized as a sort of new CEO, in fact, that the best thing you can do is ask stupid questions and not be a big ego, and just surround yourself by people who've got good answers. And I was really grateful, actually, to all of the people on my journey who've kind of informed me. And I think where I got to was that, and to my simple brain, there were three possible options, to get this, to achieve this different attitude to risk. One was a trade buyout. So, be acquired by a larger corporate, either because they found our technology exciting or useful, or that they found our customer base. And you already listed, I've listed off some of our customers as well. We've got some really interesting customers. So maybe they'd want access to those customers through us, I don't know. The second route may be through private equity, so funding a management buyout with city money, effectively, and then continue on the growth journey and essentially find a partner that had the same ambition for growth that I did and wanted to bet big and support me in that. And I think the third one was, which felt a bit out there, kind of almost on a gut feel basis, was that sort of take public IPO type thing. And instinctively, we felt too small for that, and certainly nowhere near ready for an IPO. That was what was very clear to me, even in my lack of wisdom. And also, one thing I definitely knew was that I had no desire to be CEO of a public company, certainly not for my first kind of big CEO gig, effectively. I think that would just be, well, it wouldn't be fun, let's put it like that. And I think, despite that, we didn't really take any options off the table. So we in the process, we pitched to both trade and private equity. And I think even within those categories, there were other considerations. There's like US. We've seen on the call today the different landscapes in the UK and US. And actually, we ended up with offers from both UK and US private equity. So that was an interesting thing and an interesting reflection, particularly for a business that has about 70% of its revenue denominated in US dollars in North America, effectively. And I think one of the things that I tried to do throughout the process was keep the decision making pretty simple, really. And I think certainly one of the big driving factors for me of selecting a UK private equity firm over a US one was actually doing board meetings in person. We'd conducted the whole of the transaction and the whole of the pitching process and everything on Zoom and in this environment, effectively. And so I just relished the opportunity to get face to face with people. So I got to confess I was a bit zoomed out after the whole process. So yeah, funnily enough, that was the simplest decision.
So you bootstrapped the business for many years, Adam, and you were there, in the early days, and then continued with that approach as CEO. Now that you've had a chance to work with private equity, with Living Bridge, right? Was it coming up to a year now?
Yeah, I think it's almost 10 months. So yeah, we'll be a year in August.
So how's it going? What's different? What are the key learnings?
So I think, well, the bootstrapping is interesting. I mean, like, we wouldn't be here today if we hadn't have done the basics, selling the t-shirts, selling the mugs, selling the mouse mats. And we got some great stories for that. And I think the founders claim that they were probably one of the earliest examples of crowdfunding, alongside a Def Leppard album, I think was the other one. Anyway, but we have come a long way since then. And yeah, it has been nearly 10 months now that we've been working with Living Bridge. And I can honestly say, and believe me, I didn't imagine that I'd be saying this, because there are lots, people will always tell you horror stories about working with private equity. And I received so many of those on my journey and heard from so many CEOs, what a difficult relationship that was. But I got to say, I'm still enjoying it. Now, I think, yeah, that means that for me, that means we made the right choice of partner for the right reasons. But it would be easy to say, well, yeah, it's only 10 months. You're probably still in the honeymoon period. You're still getting to know each other. You're all treading on ice, treading lightly, making friends. And yeah, and I have to say, actually, I would have said probably about 5 months ago, I would have said that's still true. But actually, whilst we haven't come to blows at all, we've definitely had some difficult, or people call them critical conversations, I suppose, along the way. And really come out stronger and had a real collaborative approach to that problem solving. So I think that's the real measure of a good relationship. Similar with marriage, right? It's exactly the same thing. If you can talk constructively about a shared problem and how you're going to navigate through that and recover from it, then that's been a real blessing in the Living Bridge relationship. And I think the learnings come they actually just keep coming, really. And we continue, we're doing more work on ourselves as leaders and as a management team and as a board than we ever have. So I think, one of the biggest learnings, I think, is that importance of having a high performing board, that culture of constructive challenge. And we definitely, we hadn't spent enough time as a management team just thinking what our behavior is towards each other and towards the team and towards the board. And I think we'd lost sight of some of those behaviors that perhaps were holding us back previously. And it took private equity, it took our new chairman as well, actually, to observe from the outside in and really just draw a big red circle around this and say, look, guys, I don't know if you know this, but ... And that's been really helpful. And I think, as I alluded to before, the biggest area of personal growth perhaps is just recognizing that it's okay not to know the answer. I think, I don't have a lot of respect for the Tony Robbins of this world, but he has a show, I think, on Netflix called I'm Not Your Guru. And I think that's a fantastic phrase, because I think people do, when you have that CEO job title, they see you as somebody who has to have the answer to everything. And when they've got a complex problem, they bring it to you, and you can sort of bat it back and say, there you go, there's your answer, off you go, execute, And I think that kind of that paternalistic style of leadership really it's really toxic, actually. It doesn't empower bright people to do good things. So I think recognizing that it's okay not to know the answer, recognizing that some of the most powerful words are, I don't know, or I'm sorry, I'll have to look it up, or I'm sorry, I'll have to speak to someone, or, it kind of sounds easy to say those words, but it takes a lot more as a leader to do that. It's about honesty and trust. And I think without both of those, you really don't get the best out of a team. Yeah.
And Adam, the team's grown quite a bit over recent months, right? I mean, how big is it now, and how competitive is the market right now for hiring?
Yeah, so I think, at the point at which Living Bridge came onto the scene, we were probably about 62, 63 people. We're now, I think the payroll is about 85 people now, and we'll finish the year probably at about 105. So you should get the sense that we're scaling quite rapidly, and probably also that we were probably quite under-resourced beforehand. So yeah, look, I think it would be pretty churlish to sit here and say that the market isn't competitive and it's super easy to hire good people. It's not. And being in Cambridge, you talked about the Silicon Fen. Being in Cambridge is great because you've got a lot of bright people. There's a big technology ecosystem here, actually, and I have to say, way better than Oxford. And I don't usually say those things. There's a thriving tech kind of hub here, but to that point, it's super competitive because I just have to throw a stone from my office and I can hit Microsoft Research, Amazon, Apple, Spotify, Siemens, you name it, they're all here. So, and those guys are the ones that are paying the big salaries because they can, right? And for a smaller organization like ours, and one that, despite the journey we've been on, we still have a budget. We still have to be quite cost conscious in a way, despite the fact that we're trading profit for growth. We still have to be careful. So yeah, it's super competitive. And what the important thing there really is thinking about the whole package. And it's almost like the way you think about product. What's your unique selling point? How are you different in the market? What can you offer good talent that other people can't? What's your, I think the buzzword these days is employee value proposition, right? What's your EVP? Way beyond the salary, and it's much like investment. I think I said to you before, Alexi, everybody's pound is worth a pound, and it's the same with salary. Everybody's pound is worth a pound. But if you can show people that, whether it's through culture, whether it's through, whether it's through values, whether it's through your attitude towards ESG, which is an incredibly important thing, particularly for the up and coming graduate generation, that's something they're really, really focused on. And as well they should be. So if you can differentiate on those vectors, then I think you can still be competitive, but you have to get creative, and particularly when you're surrounded by these 400-pound gorillas in the Silicon Fen.
So quick reminder for everyone who's dialed in here, feel free to submit any questions using the Q&A button at the bottom, and we'll try to find time to get through some of those. But while those are coming in, I'm going to carry on here because I've got a few more questions for you, Adam. So tell me a little bit about international expansion. Is that something that you thought about? What are the key considerations? You mentioned that a big part of your revenue is based in the US. Is that changed now that you've got private equity partners on board?
I think I've been having this conversation for years about we've particularly because we've got such a customer base in the US, having a sales and support function out there. Because we don't run 24/7 in our support operations, we don't run 24/7 in our sales operations. Would that help? Almost certainly, yes. And I think no matter what people say, having a US accent when you're doing sales calls to North America is actually really important. And also, I think it's really easy to assume that because the US is English speaking and so are we, that the cultures are very similar. And that couldn't be further from the truth. When you talk about marketing and tone of voice and brand perception and all this kind of thing, actually, you do have to address the US market in a really very different way. So I think so that conversation of should we be in the US is almost, it's now become a when, not an if. And there are, there's some hiring we need to do to unlock that, and there are some learnings we need to go on. And the brilliant thing about having private equity, by the way, is that having that cohort of portfolio companies who've been there and done it, who've gone from a single office in a single UK town to having, points of presence in the US, in Asia, in South America, and can really advise on the traps and the pitfalls, and so we can avoid them is super helpful. No matter what people say about I talked about the private equity horror stories, there is so much value there if you know how to work with it, and if you address it right. So it's definitely a when, not if, and I think the US would certainly be first, because that's just a no-brainer, definitely.
So switching to a slightly more random question now, because I know that there's a whole plethora of different ways in which the RealVNC technology is being deployed. What's the most unusual application of RealVNC technology you've been made aware of?
Yeah, so unusual is a tricky one. I think so one thing I definitely heard, and I don't know the exact use case, was around a sort of a survey that was tracking polar bears around. Now I'm going to show my ignorance, whether it's the Arctic or the Antarctic. I'm sure you can tell me, Alexi, whether polar bears are in the Antarctic or the Arctic. But yes, one of those. And so they put sensors on them, effectively, and they were using VNC to control the edge compute device. So this is it's a bizarre IoT use case. So they used VNC to access the very remote edge compute device that was aggregating the data from all these sort of wireless sensors around polar bears' necks, I suppose. And yeah, so they were using VNC to do regular maintenance, pull data off, and all kinds of things. So that's definitely the weirdest one.
Love it. So just conscious of time here, so I guess one more question from me, Adam, before we wrap up. You talked a little bit about board composition. Tell us a little bit about your views on the importance of the chairperson role, and any advice that you've got for founders or CEOs.
Yeah, I mean, so in selecting a chair, that was a really interesting thing as well, because I think our process was really looking at the business and looking at where our gaps were. And I think because we'd been founder-led for such a long time, and we had highly technical founders, one of the things that the business perhaps was less adept in was the commercial side, the getting really watertight on those sales motions and customer success motions and that sort of thing. So I think when we were looking for a chair, what we wanted to do was have somebody who could really fill those gaps and have connectivity into that world and effectively advise us, introduce us. So firstly, super piece of advice is get a really uncomfortable chairperson. You know, I'm super comfortable with the technology. You know, I can talk tech till the cows come home, and that's very easy. But actually having someone who's going to challenge on the commercial side of things, that was really important. And then building that CEO chair relationship is an interesting one, because I think the way I've come to see it is the chair is the interface between private equity and me, effectively, because it's kind of important that I don't fall out with my investors. So much like this is going to be a really horrible analogy. Now I'm on the fly here, but yeah, much like with an estate agent, right? There's a reason they're in the process, that the buyer isn't talking to the seller directly, because they actually need to get on. And it's exactly the same thing. So the chair role is great at mitigating, for example, when you've got bad news that you need to deliver into the board, you know, how you go about that, what the right way to land that is, and do you do it ahead of the board meeting? Do you do it at the board meeting? Is surprise bad or good? And, you know, all these kind of things, and also doing a bit of coaching back. So, you know, after our first few board meetings, David phoned me up and said, look, you know, just want to do an hour reflecting on how we're performing as a board, and I've got some feedback from Living Bridge on your performance. You know, I want to take back your feedback to them as well. You know, I want them to know what you need more of or less of, or what you valued, what you didn't like, or all of those things. So I think having that role as a kind of a mediator, but not someone you whinge to, definitely not someone you whinge to, but someone whose job it is to ensure that as a board we're performing at our best. And for us, what that looks like is actually spending less time on it being a theatrical piece. You know, I don't want to go to a board meeting and feel like I'm giving a performance. I want to go to a board meeting feeling like I'm collaborating on solving some key problems or celebrating some key achievements in the business. But if it feels like a performance, then you're probably doing something wrong. And that was actually some of the early advice, really. And I really treasure that.
Well, thanks for sharing that with Adam. We're going to have to leave it there. Thank you, Adam.
Pleasure.
And thank you for really taking the time to share all your thoughts and experience with us so openly and honestly. So with that, I'd like to thank our guest, Adam, our speakers, Matt and John, as well as all of you for joining us this afternoon. If you do have any follow-up questions, please don't hesitate to get in touch with any of us or me directly. We will share a recording with all the attendees after the session. You can also download the full Q1 software update report using this QR code here on the screen. And I'd like to wish everybody a great Jubilee weekend, and we look forward to seeing you all next time.